Hello and welcome everyone to today's Lunch and Learn session on the Irish anti-hybrids legislation. My name is Gareth Bryan, and along with my colleague Cormac Golden, we're going to give you a high-level walkthrough of the anti-hybrid rules, which we'll be doing with a little bit of theory first, but then we'll be mostly focused on going through practical examples to try and illustrate the rules. Please note that this session is being recorded, and we're going to make that recording available after this session. So, if we can get started. What are the anti-hybrid rules and why do we need to worry about them? These rules have come into force, so they're in force from 1 January 2020, and therefore they're going to be relevant for tax provisioning work and tax returns relating to 2020. So they are of immediate concern to people attending this seminar. So what are these rules and when do they apply? Well, they will apply where we have a cross-border mismatch arrangement between associated enterprises, and that results in a deduction without inclusion outcome or a double deduction outcome. So we're going to go through each of those three concepts, and then we're going to apply them to a series of examples. The rules are complex, so we're not going to get into the absolute fine detail on all of these points. We'll try and illustrate the key issues. So we move on to the next slide. So firstly, we need to have a hybrid mismatch outcome. And so what are those? Well, there are essentially 6 that are provided for in the law. We start at 12 o'clock on the diagram. We've got double deduction outcomes. And essentially, this is where a tax deduction is taken for the same expense in 2 jurisdictions. And the simplest way to think of that is maybe an Irish company with a branch, say, in the UK. And the UK branch will file a tax return in the UK and will take a tax deduction for its costs. But also the Irish company will tax its worldwide profits, including its UK profits, and thus will take a deduction for those expenses of the UK branch too. This rule doesn't have any negative application as long as the income against which that expense is deducted in both countries is taxed, is included in both countries, which would generally be the case with an Irish company with a foreign branch. Secondly, then, financial instrument mismatches. This is probably best illustrated by interest, say, on a loan, and where you're getting a tax deduction in the payer jurisdiction, but that interest is not included, that is not taxed in the recipient jurisdiction because of the character of the interest. So it's got nothing to do with the tax regime as such of the recipient jurisdiction. There might be no tax in that jurisdiction, for example, in the Cayman Islands or Bermuda, but it's where non-taxation arises because the 2 jurisdictions characterize the interest differently. So maybe a loan that has equity type features might still qualify for a deduction in the payer country, but the recipient country might say, no, this is much more like a dividend. We have an exemption for dividends, we won't tax it. And that's the kind of situation that is called with a financial instrument mismatch. Branch mismatches can arise where there are profits that are allocated to a branch and they don't get taxed anywhere. And that would classically arise for some countries where they don't tax the profits of their foreign branches, which Ireland does, but other countries don't always do that. But so they might say, we think we've got a foreign branch in a foreign jurisdiction, we won't tax that. But that foreign jurisdiction might say, look, we've different rules around what we think a branch is, and maybe there isn't enough activity in our country for there to be a branch. So we're not going to tax that either. And so the profits fall through the cracks. That is caught by these rules. Tax residency mismatches. This is where the residency rules in 2 countries are different, and therefore a company maybe is not taxed anywhere because it's incorporated, say, in one jurisdiction and managed and controlled in another, but the rules in those countries are such that those local tax authorities don't consider the entity to be resident in their country because they've got a different rule, a corporation rule versus a management and control rule. So again, profits not being taxed anywhere. Hybrid entity mismatches, and these are payments to hybrid entities and payments by hybrid entities. What are hybrid entities? Hybrid entity is an entity where the tax authorities in 2 countries view the entity differently. And that would typically be tax authorities in one country thinks this is a separate person, a taxable person in a country, and the tax authority in the other country says, no, this is a transparent entity, maybe like a partnership, and we will look through it. And the classic example there might be a US LLC. And normally, in most cases, a US LLC, its default position is that it is not taxed in the US, but it is still a company. And if an Irish company was making payments to a Delaware LLC, a US LLC, typically we would say, oh, that is a payment to the Delaware LLC. and that is a foreign entity, and that entity has received that payment. So you could result in income, again, not being taxed somewhere, being deducted in Ireland, a payment of interest, say, to an LLC. But the US says, no, we don't tax LLCs, and therefore the income is untaxed. And we'll pay particular attention to these hybrid issues in some of our examples, because they're going to be particularly relevant, I think, to the people on this call. And finally, then, withholding tax mismatch can arise where essentially there are arrangements in place, like a stock lending type transaction, where it results in foreign tax credits, that is, withholding taxes on, say, a payment being credited against income in two jurisdictions. And that can arise where there are different rules around who's entitled to tax credits. Again, it's okay if the income is taxed in both, the same income is taxed in both countries and the creditor is claimed against that, that's okay. It's when the income also falls out of charge in at least one of the countries. And finally, wrapping around all of these is the idea of an imported mismatch. So we'll look at these, principally we will look at these mismatches where there's an Irish company, say, making a payment or taking a tax deduction. But there are also rules that say, look, sometimes you need to look beyond the immediate transactions with Ireland because maybe they're not caught by these rules. But if you're part of a structure, you're part of a group, and there are mismatches further up the group chain, maybe in countries that are outside the EU, so technically these rules don't apply. But if there are things that would have been caught by the rules had this been in the EU, then there are going to be consequences in Ireland, because if you're funding that out of Ireland, then we want you to block tax deductions in Ireland or tax income that would otherwise be exempt in Ireland. And we'll illustrate this through our examples. So the next slide, please. As I said, we have to have a cross-border mismatch between associated enterprises. So when are you going to be associated? Main tests around association are around share capital, ownerships of equity type interests, voting power, or entitlement to profits. So that's very much around kind of equity type measures where you're under control or under common control. It wouldn't include profit participating debt. So although that kind of has profit participating has a kind of equity type character to it, that's not caught by these rules. And the threshold then for commonality depends on which mismatch you're looking at. There's a table there which summarizes them. For many of the ones that are most important, I think, to the people on this call, it's a 50% threshold. But you can, outside of that, still have an association. So if you're included or would be included in an accounting consolidation, looking at international accounting standards or Irish GAAP, then you can be associated. Or if there's significant influence in the management of a company through the board. So for example, you might have a less than 25 or 50% relationship, but maybe you've got rights to appoint board directors and act on decisions through the board that way. Then you could be connected. So the next slide, please. And finally, deduction and inclusion. And some of these might seem reasonably obvious, but worth touching on them because there are some unusual aspects that need to be thought about. Deductions are what you might think they are. Things that are deductible against your profits, but also things like capital allowances, things that reduce your taxable base. It won't generally include notional deductions. So some countries, for example, give tax deductions for interest-free loans. They say, well, it's an interest-free loan. We'll give you a notional deduction for interest that would have been charged had this been arm's length. They are not included in the Irish rules, nor are notional deductions that are sometimes given on equity. Transfer pricing adjustments are also not included as a deduction for this purpose. Inclusion then is at its basic level what you might think it is. It is included in the taxable income of the recipient. That's straightforward enough. But we need to think about other situations where there might not be a mismatch, there might not be any tax planning or any kind of tax structuring going on, but there might not be tax paid by the recipient. And the obvious example, which is the second bullet in the middle column, is the entity is a tax-exempt entity like a pension fund. So income will still be included where it is received by a tax-exempt entity, and it is generally tax-exempt, notwithstanding that tax isn't paid. But we still say that's okay. Similarly, we will say that it's included if that territory where the entity is established and managed is one that has no tax, because this isn't about, these rules are not about tax being paid per se, but it's about a mismatch that means that tax that should have been paid has not been paid. So income received, say, by a Cayman company, that can be treated as included. Similarly, then, some countries only tax local source profits, and Hong Kong is a very good example of that. Territorial regime only taxes Hong Kong source income. That's a policy choice at a local level. It's not about a hybrid mismatch. Therefore, we will treat that as included. To note, there is a distinction where a country might have a remittance regime, which says we only tax income when it's remitted into our country. Singapore, good example. In some cases, in Malta. In those cases, the Irish will say we will only treat that as included if and when it's remitted, and thus subject to tax. And then finally, there is a rule that says, look, maybe you haven't directly remitted this money to our country, but maybe it's in an offshore subsidiary, and the parent country, or the country where the parent company is located, charges taxes through a controlled foreign company regime, like the US Subpart F rules, the Canadian FAPI rules, or classic EU CFC rules. And therefore, if tax is picked up through that mechanism, then we will consider that to be included for these purposes. So then finally, there's an aspect to the Irish rules which is really important, and it's not replicated consistently across the EU, but it's really important in particular when we're talking about US foreign direct investment. And that is, you can have inadvertent mismatches that arise because there's worldwide taxation of profits. And a simple example might be, again, an Irish company might have a branch in the UK, and it might also have a branch in Germany. And as I said earlier on, if there's deductions being taken in the UK for its operating costs, they would also be deducted in Ireland. As I said in the earlier example, that's okay as long as the income of the UK branch is also included in the Irish tax return, which would normally be the case. But consider the possibility that the UK branch might do some trading with the German branch. The income that's taxed in the UK is the income that the UK branch earns from the German branch. But in Ireland, the branches are all part of one entity. It's all one big pot. There isn't a separate inclusion of the income that is earned by the UK from the German branch. There isn't a separate deduction that the German branch would have gotten as part of the computation of the Irish profits. Instead, we just look in Ireland to the external profits of the whole entity and the branches. So you could, in theory, have a mismatch. The Irish rules have allowed for this. And said, look, where that is the cause, where there's a payment that is disregarded, but it's because we've got worldwide taxation, we won't have a mismatch. And that's really important for US check-the-box entities, where you may make these elections under US rules that treat foreign subsidiaries as if they were branches of a US parent or US owner. And these same issues can arise. And the Irish rules have allowed for this, but other countries have not. And that's going to be really important. And that's an important distinction in the Irish rules, whereby we should avoid the application of these rules in lots of cases because of these rules, but you need to think about subsidiaries in other EU countries and whether or not that can have an impact. So we're going to go through a few examples now, which Cormac is going to lead us through, and we'll illustrate, hopefully, as many of these concepts as we can. There is a Q&A function. Please feel free to send in questions as we go along. We may try and answer those. We'll have time at the end as well. So Cormac, over to you.
Thanks, Gareth. So the first category of examples that we're going to look at are deduction without inclusion mismatches, which involve hybrid entities. So in our first example here, we have a US parent company, and it has a Maltese subsidiary, which is lending down to an Irish company. And so there's an interest payment being made from the Irish company to the Maltese company. In this case, the Malta company is a hybrid entity, as it is a company for Maltese tax purposes, but it's made a check-the-box election. And so it's considered disregarded from a US tax perspective. So because we're making a payment to a hybrid entity, we need to consider if we have a deduction non-inclusion mismatch outcome. Here we have a deduction for the interest payment in Ireland, so we have a deduction, but the income is subject to tax in Malta, and so we have inclusion at the level of the Maltese company. And so for this example, it's quite straightforward. We can sort of stop at that level. We have a deduction, but we have an inclusion of that income, and so a mismatch outcome doesn't arise.
And maybe this is a good way to answer a question that's come in on the chat, which is, do we need to think about inclusion everywhere? So as Cormac has said, because the Malta company has made a check-the-box election for US purposes, its income is treated under US tax rules as also arising to the US parent. Well, under the Irish rules, the Irish revenue guidance says no. Irish revenue guidance says you only need to find a payment being included once and in one location. So although it might also be included in other jurisdictions, you don't need to think about that. Find one instance where it's included, and that would be sufficient. You go no further than that. And the second question that was brought up is, does a payment need to actually be made to be caught? What about accruals? And that is, a slight anomaly almost in the rules. Obviously, an Irish trading company might be taking deductions for this interest payment on an accruals basis, but the payment may not have been made. Ultimately, payment does need to be made to trigger the rules, and that theoretically could have a retroactive impact in that you might not pay it until the following year. And generally, there isn't a timing issue. There's one exception where timing is relevant. We'll come to that in a later example. But that does mean that there can be a retroactive element here, but ultimately, the rules do talk about payments being made. So ultimately, a payment would have to be made.
Great. So if we move on to our next example. The next example, when you look at it, looks very similar, but there is a subtle difference here. So in this case, we have the same fact pattern, and the Maltese company is a hybrid entity because it's made a check the box selection for US purposes, but it's also not incorporated in Malta. And so the income that the Maltese company receives is only taxable on a remittance basis. So that touches on the point that Gareth made previously. As a result, we have a potential hybrid mismatch outcome here. We have a deduction in Ireland for the interest payment that's been made, and that income is only taxable in Malta when it's remitted into Malta. So to the extent it's not remitted, there's no inclusion at the level of the Maltese financing company. And so there's a potential deduction non-inclusion mismatch outcome as a result. That would serve to restrict the deduction for the interest in Ireland. But it's also potentially possible to test for inclusion at the level of the US parent company. The Maltese company here is disregarded, and so we can look up to the US parent company as an additional payee territory, and we can see if the income is included there. So in this case, the Irish company is paying interest to Maltese company that's disregarded, so it's effectively treated as having been paid up to the US parent company. And so if that interest income is subject to tax in the US, then a deduction non-inclusion mismatch outcome could be avoided here.
And so this really does illustrate the point, Cormac, around the fact that you can, at your option, essentially test for inclusion at multiple levels, but you're not obliged to. Once you've found inclusion once, you should be okay. And this implementation of the rules in Ireland, and again, it's not necessarily going to be consistent in other EU countries, is really important. There's been a kind of broad and liberal implementation of the rules in Ireland that says, look, yes, you can look through. You don't need to just look at the immediate recipient. As long as the income is being included somewhere and taxed, then we will accept that as included. And that's logical because obviously that is consistent with the overall aim of the directive, which is to make sure that where something is deducted, that it is included in the manners we've described somewhere, and that you don't necessarily need to stop at one level. But again, not every country in the EU has gone into this level of detail and granularity. And so either this result might not be respected in some other countries if they replaced the Irish company, or indeed it might be uncertain. So while this is a very good result from an Irish point of view, you shouldn't assume that you'll always get the same result for equivalent structures in other countries.
Yeah. So in our next example, we have another remittance-based regime. So in this case, we have an Irish company, and it's the Irish company in this scenario that's the hybrid entity, as it's a company for Irish tax purposes that's made a check the box election, and so it's a disregarded entity from a US tax perspective. So again, here we need to consider if there's a deduction non-inclusion mismatch outcome. So we have a deduction for the royalty payment being made in Ireland, and that royalty payment will only be taxable in Singapore when it's remitted into Singapore. So potentially, again, here we have a deduction non-inclusion mismatch outcome. And in this case, it differs from the previous scenario where Malta was the disregarded entity. And so we could effectively look through the Maltese company and look up to the US parent company and test for inclusion at that level. In this scenario, the Singapore company hasn't made that election. And so we could only test for inclusion at the level of the US parent if the results of that Singapore company were taken into account in a form of CFC or guilty charge. If that was the case, then potentially you could still meet the inclusion test at the level of the US parent company. But otherwise, we could be in a scenario where there's a deduction in Ireland and there's non-inclusion in Singapore until that income is remitted into Singapore. And
just as a way of illustrating a broader point, although this example is focusing on deduction without inclusion, when you're looking at any structure, you really do need to think about the full breadth of the hybrid rules and to think about each of them in turn and how they might apply. So in this example, we would also have to think about the fact that we could have a double deduction hybrid mismatch too. That's because the Irish company has elected to be treated like a branch of the US parent company, and the Singapore company is not. So that deduction for the royalty payment that the Irish company takes in Ireland is also the deduction for the US parent. So you'd have a double deduction of that payment in those circumstances. Of course, as long as the income against which that deduction is taken is included in both countries, that's okay. So, and that would generally be the case where you have an Irish company that is elected to be a branch of the US parent, because then the parent, yes, takes a deduction for the same expenses, but includes all of the same income. And just to answer one quick question that came in over the chat, which is what happens if you've got more than one parent entity or investor that might have a 25 or 50% relationship with the entity? Do you need to have inclusion in each? The answer would be essentially yes. And if you had inclusion in one but not in the other, it would be proportionate. So if you had interest payments to, say, two shareholders in a JV structure and you had notes issued, you would look at them separately, and you would look at the extent to which there was a mismatch outcome, and the restriction would apply to that extent only for that entity.
Yep, so if we move on to our final deduction without inclusion example. So in this case, we have an Irish company, and again, it's made a check-the-box selection. So from a US perspective, it's disregarded. And so it's a hybrid entity as a result. And it's paying interest on listed debt to a Cayman company. So again, we have a payment by a hybrid here, and we need to test if there's a deduction without inclusion mismatch outcome. In this case, the Irish company is taking a deduction for the interest. And touching on the point that Garrett made previously, that income should be deemed to be included in the Cayman company, even though while it's included there, it might be subject to a 0% rate of tax. It's still included from the perspective of the Cayman company. And so we get out of our deduction non-inclusion mismatch outcome here. One important point to note, though, is that the payee, when you're looking at the payee territory, the payee has to be established in that territory. And established for these purposes is linked to where the effective place of management is. So an issue could arise here if the Cayman company wasn't actually deemed to have its effective place of management in the Cayman Islands. Where this potentially could arise, or might need to be considered further at least, would be, for example, where you had US directors acting for the Cayman company from the US. And if we fell into a scenario where the place of effective management was actually deemed to be in the US, then you'd need to test for inclusion from a US perspective, as opposed to from a Cayman perspective.
And that point is really important around making sure that the establishment remains, in this case, in the Cayman Islands. And what the rule says is, initially you look at the place of incorporation, but if the place of effective management is different, then it's the place of effective management. Of course, the introduction of the substance requirement rules in places like Cayman and Bermuda and the Channel Islands over the past couple of years is helpful, because there is an alignment there in meeting those substance requirements by holding board meetings in those jurisdictions, and as appropriate taking other actions there would help align that position around ensuring that the place of management remains in that jurisdiction. But it is something that needs to be actively managed. And one question that came into the chat, which just to illustrate it here, was if you have listed notes, so they're on a stock exchange somewhere, do I need to worry? And the answer is yes. The fact that something is listed does not take you out of scope of these rules, but bear in mind you need to be associated within the meaning of the rules. As I mentioned earlier on, so there is a 25% or 50% equity type relationship. And although PPN's profit participating notes, if that was the listed debt, might have some of those features, they're not caught under these rules. So you would need to have an actual shareholding type relationship. So it's presumed that you would know who your 50 or 25% shareholders were. The other routes is through accounting consolidation or through significant influence. And again, the presumption there is, look, you can have accounting consolidation potentially through listed notes, but you need to have a very large stake for that to be the case. Or you would need to actually have some kind of significant influence over the issuer. So again, there's a presumption that you would be able to identify such debt holders in those circumstances. So you're not looking for all the debt, but you'd be looking for people who've got a very substantial quantity for your debt, and generally that would need to be profit participating as well.
Okay, so if we move on to the next category of mismatches that we're going to look at, these are the double deduction mismatches. And we've sort of talked briefly through them already, but to give a very simple example of when this could arise. So we have a US parent company here, and it has an Irish subsidiary. Again, the Irish subsidiary has made a check the box selection, so it's disregarded for US purposes. It's effectively treated as being a branch of the US company. So from an Irish perspective, we have a deduction for the interest payment that's been made to the third-party bank. And because the Irish company is effectively treated as being transparent for US purposes, the US company is also considered to have made that interest payment out to the third-party lender. And so we have two deductions for the same interest payment here. So in this case, a mismatch outcome will arise where we have double deduction, but only to the extent that there isn't dual inclusion of the same income. And so here, the Irish company is earning income on its trading activities. And because it's a disregarded entity from a US perspective, the US company is effectively that trading profit that's earned by the Irish company also flows up to the US company, and so it's subject to tax in the US. So here we have a deduction for the interest payment in Ireland, a deduction for the interest payment in the US, but that same income that's earned by the Irish company is also subject to tax in Ireland and the US. So we have dual inclusion of the income, and so a mismatch outcome doesn't arise as a result.
And this concept is obviously really important, the idea of dual inclusion, and that you will be excluded from these rules where the same income is included in both jurisdictions. An important aspect of that is around timing. You could find that there are timing differences, or you might find, for example, that you have tax losses forward in one jurisdiction, which means that maybe that income isn't actually taxed, maybe not the same year, or it might be effectively deferred through loss carry forwards in one country that aren't available in another. That in itself shouldn't be a problem as a general concept. There is one particular instance which we'll come on to where timing is relevant, but the issue here is it deductible as opposed to deducted against dual inclusion income, and with that one exception which we'll come on to, there isn't actually a requirement that the income is taxed in the same period. One follow-up question that has come in over the chat on the previous question, which was, if I have listed notes, do I need to worry? And yes, you do. And maybe an obvious follow-up question is, well, what if we don't know who all of these people are? Well, ultimately, if you were unable to establish a position, the rules would say that if you can't prove, effectively you can't prove inclusion, you can't assume it. So you would need to be able to say that, yes, we know there is inclusion in a country, and if you can't demonstrate that in those circumstances, then you would probably have to deny the deduction as the default position.
So if we move on to the next example, this example is very similar, and to touch on a point that Garrett had made previously, there might be a range of payments that are made by the Irish company where you need to consider the double deduction mismatch outcome rules. But in this case, we're just focusing on a deduction that's been taken for tax depreciation. So again, we have a US parent company. It owns an Irish subsidiary that's been checked open, and so the Irish subsidiary is a hybrid entity. That entity has an aircraft that's on lease to a third-party airline. So at the level of the Irish company, we have a deduction for capital allowances on the value of the aircraft. because the Irish entity is disregarded, deductions also taken for tax depreciation at the level of the US parent. So again, here we have a double deduction for the tax depreciation. So to ensure that we don't have a double deduction mismatch, we need to test to see if there's dual inclusion of the income. So here we have the third-party airline is making lease rental payments to the Irish company, so there's inclusion at the level of the Irish company. And again, because that's disregarded for US tax purposes, there's also inclusion at the level of the US parent. So the lease rental payments effectively flow up and are included at the level of the US parent company. So again, here we have a double deduction for the tax depreciation, but that's alongside dual inclusion of the lease rental income. So a mismatch outcome doesn't arise as a result.
Yes, so, and again, timing differences with depreciation, as I mentioned earlier on, that generally isn't going to present a problem. So tax depreciation in Ireland on say, a leased asset will be typically 8 years. In the US, it can be different, about 12 years, for example, depending on the particular asset. Again, the fact that there might be timing issues and therefore the income itself isn't taxed effectively until later periods in itself shouldn't cause a problem. One of the questions that came in, we have inclusion here, it's around inclusion in the US. Here we have inclusion because the Irish entity is elected to be treated like a foreign branch of that US parent. We've said separately that things like subpart F, if there was a subpart F charge in the US on a foreign entity that was not treated like a branch, we would treat that as included. So what the Irish, and the question was, how broad is that in terms of what regimes are covered? What the Irish rules say is that it's anything equivalent to the Irish controlled foreign company type rules. And then there's revenue guidance around that, which does make reference to subpart F. So things like US GILTI would generally be in, so would Canadian FAPI, UK CFC, US subpart F. So I think you could interpret that reasonably broadly, bearing in mind that the mere fact that there might be a subpart F charge or equivalent, you can't just stop there. You need to obviously be sure that that charge picks up all of the relevant income. So GILTI, for example, there are only thresholds above which GILTI applies. So it's above a certain return on assets, you can have a GILTI charge. So you might find that some is excluded under those in those contexts. So you do need to think about, just because there is a charge at the parent level, you need to make sure that you have total inclusion. And if you don't, then you would have a proportionate restriction in Ireland. It wouldn't be a full restriction, it would be proportionate.
Move on to the next example. So this example is quite similar. There's just a variation on how the aircraft is leased. So in the US parent company, it owns an Irish subsidiary which owns the aircraft, and that Irish subsidiary then leases the aircraft to a UK subsidiary which subleases the aircraft to the third-party airline. And in this example, we also have a third-party debt which is being used to finance the aircraft. So we have interest payments being made from the Irish company out to the third-party lender. So if we focus on this potential double deduction rather than the tax depreciation one in the previous example, we have a deduction for the interest payment in Ireland. Because the Irish entity has made check the box selection, there's also a deduction for the interest payment at the level of the US parent. And so we have a potential double deduction mismatch outcome in respect to that payment. So again, we need to test for dual inclusion of the income to ensure that a mismatch outcome doesn't arise. So one interesting point here is whether you're required to test for dual inclusion of the same income. So here, the Irish company, the income that's included at the level of the Irish company is the head lease rental payment that it's receiving from the UK subsidiary. So the Irish company has included that amount, whereas from a US perspective, because the Irish company is disregarded and the UK company has also made the check the box selection and it's disregarded, it's the sublease income that's been included at the level of the US company. So potentially that could be problematic because you don't have dual inclusion of the same income. It's the head lease in Ireland and the sublease from a US perspective. But in this case, the worldwide system of taxation rules that Gareth mentioned previously are helpful. And what they effectively say is that where you have a a double deduction mismatch outcome, and that arises because there isn't dual inclusion. But the only reason that there isn't dual inclusion is because there's a payment between hybrid entities that's disregarded. Well, then you can effectively treat that disregarded payment as being included. So in this case, the head lease payment from the UK to Ireland is disregarded from a US perspective because the UK and the Irish company are both disregarded entities. But we're effectively able to treat that payment as being included, and so then we have inclusion of that payment in Ireland, and it's also deemed to have been included from a US perspective. So we have a double deduction, but that's offset against dual inclusion income, and so a mismatch outcome doesn't arise as a result.
And obviously, that result is absolutely sensible and makes sense. And it would seem perverse if you had a situation where, like this, you had a restriction in Ireland as a consequence of the fact that you've got this, that ultimately there is a taxation in the US of all of the profits of what are its foreign branches, but that you would have, because of the fact that there's transactions between those branches, that you would have a restriction. So this is absolutely sensible. As I said earlier on, it's not always the case that other EU countries have thought about this in the same way, and some get there through various means. Some are maybe through a principles-based approach. I think that still leaves some ambiguity and uncertainty, but you might get there. I think the fact that Ireland has legislated for this and given clear guidance is really helpful, but you shouldn't assume that if you had another EU entity in the place of the Irish company here, that you would necessarily get the same answer in that country. And one point to bear in mind here is, I know we've kind of, a lot of our examples here are looking at entities that have treated as a check the box disregarded entity of a US parent. Exact same position applies to any entity looking at foreign branches. So we have Irish Co and UK Co here with the circle through them to indicate it elected to be branches for US tax purposes. It's exactly the same situation as if they were actual branches in the Ireland and the UK of a US parent, or an Irish branch and a UK branch of a German parent or anywhere else. So the exact same principles apply. They are in no way unique to this check the box question. The same issues arise in terms of the possibility that there could be transactions between an Irish branch and a UK branch of a German parent that might not be included in the same way in the German parent's tax return, because simply the German parent might just tax the entirety of its worldwide profits if it does tax its foreign branches in that case. So these principles absolutely apply in other cases as well.
Yep, so if we move on to our next category of examples, these are the imported mismatch provisions that Garrett mentioned earlier. So in this example, we have US investment and non-US investment that's been made into a Cayman company. And then the Cayman company has a Hong Kong subsidiary, and then there's an Irish subsidiary of that Hong Kong company. And so we have a loan coming down from Cayman Islands to Hong Kong entity, and then a loan down to Ireland. So I suppose, step back, the first thing we need to consider is, do we have a direct hybrid mismatch outcome? So that interest payment that's been made from Ireland to Hong Kong, we have a deduction for the interest in Ireland. So we need to test for inclusion at the level of the Hong Kong company. And as Garrett mentioned previously, when we look at the definition of inclusion, payments to Hong Kong fall in the meaning of that definition, because Hong Kong operates a source-based or territorial tax regime. And that's one of the types of regimes that's included in the definition. So we have a deduction in Ireland, but we have inclusion at the level of the Hong Kong company, and so a direct mismatch doesn't arise here. However, because the payment's being made outside the EU, we also need to check to see if that Irish interest payment is funding a mismatch that occurs further up the chain. So we need to look at the Hong Kong company, and we need to see if a hybrid mismatch could arise in respect of any payments that it's making. So it's making an interest payment up to the Cayman company, deduction being taken potentially at the level of the Hong Kong company. and it itself is a hybrid entity because it's filed a check the box election. So again, we need to test for inclusion here at the level of the Cayman company because we have a deduction at the level in Hong Kong. And so we need to ensure that there's inclusion of that income. When we look at the imported mismatch provisions, we're applying the Irish principles when we're looking at that. So from an Irish perspective, we would say that there is inclusion of the income in the Cayman company because payments to payee territory where a 0% rate of tax is applied, they can be considered to be included provided that that Cayman company is established in the Cayman Islands. And so you can look at it from a Cayman perspective then. And that goes back to one of the examples that we went through earlier on. So again, here we'd have, or we have to look at it from an imported mismatch perspective. We have at the direct level a deduction in Ireland but inclusion in Hong Kong, and then we have a deduction from in Hong Kong but inclusion at the level of the Cayman company. And so we don't have an issue from a direct or an imported mismatch perspective.
And Cormac, I think this requirement to consider imported mismatches is going to be one of the toughest elements of applying these rules in practice, particularly for people who are administering entities as part of a group structure where maybe they don't have a role or good oversight of the rest of the group. And that itself is no out from these rules, and it will be necessary essentially to conduct an investigation to establish that you don't have an imported mismatch issue. And if one were ultimately determined, then there could be a problem with that. As a practical level, the imported mismatch piece is something that there's a risk that people might overlook it, they might forget it and focus just on the immediate payments. But it is something that really needs to be carefully considered in all of these structures. And I would say it's something that probably doesn't get enough thought in advance of people thinking about preparing their tax returns.
Yeah, that's right. And I suppose if we move on to the next example, we'll see one piece that's helpful about how the Irish imported mismatch rules have been drafted. So from an Irish imported mismatch perspective, if the payment is being made to an EU recipient, we can effectively stop there. And that's because the hybrid rules came in as a result of the EU Anti-Tax Avoidance Directive. And that effectively required all member states to bring in anti-hybrid legislation. So from an Irish perspective, we look at a payment here to Luxembourg, and we don't need to consider the imported mismatch rules further, and that's on the assumption that to the extent there is a mismatch in the chain further up, the Luxembourg rules will pick up that anyway. So that's helpful in this scenario. We only really need to consider the direct mismatch provision. So do we have a mismatch on that payment from Ireland to Luxembourg? And so if we look at that, we have a deduction for the interest in Ireland, but that interest is subject to tax in Luxembourg. And so we don't have a deduction on inclusion mismatch outcome there. So from a direct perspective, we're okay. Maybe just to touch on if the fact that there's a Delaware LLC here in the chain. So if we were required to look at this from an imported mismatch perspective, or potentially when we have to consider the Luxembourg anti-hybrid analysis, and obviously their rules can differ. If we take it from an Irish perspective, we have an interest payment going out to the Delaware LLC. And when we look at inclusion at the level of the LLC, so that income wouldn't be subject to tax at the level of the LLC. It will flow up to the US investors. So when we're testing for inclusion, we need to look up through the LLC and see is there inclusion at the level of the US investors, and if it's subject to tax there, potentially if there's tax exempt entities involved, we probably have inclusion on that piece of income. However, when we then look at the non-US investors, it potentially can arise that they won't see that Delaware LLC as being a transparent entity, and they may see it as being opaque. And in that case, we'd have an interest payment from Ireland or from Luxembourg, that's deductible. It won't be included from a US perspective at the level of the LLC. And if we can't look through the LLC and up through the Cayman partnership to the non-US investors, we could have a case there where we don't have inclusion of that income. And so potentially you could have a deduction non-inclusion mismatch outcome there as a result.
And just to touch on the main principle of this example, which is that, we don't need to look beyond Luxembourg because Luxembourg is in the EU in terms of doing the Irish analysis. That is an option that was made available to member states. So it is not necessarily the case that would always be the situation if you had, if instead of an Irish company, you had another EU company in the mix. For example, the UK, obviously prior to it leaving the EU, hadn't taken that that option, and therefore would have had to do the onward analysis. And maybe just as an illustration of a question that had come up earlier on, which is, let's say we have this Irish company and let's say it has third-party expenses. And, do you have to look for, what if you've got more than one owner and where do you look to inclusion? So here you could then have a deduction in Ireland for those expenses, but because it's a flow-through entity and elections have been made to treat as branches, and then also those branch profits could be taxed by the US investors up the top on the left-hand side, and thus they could be taking deductions for those expenses. So again, the fact that they do take a deduction for their share of the Irish company's expenses is okay, as long as they are including their share of the Irish income. And again, that can be through any of the measures of inclusion. On the other side, of course, you've got these non-US investors. Well, generally, if you're talking about non-US investments, so an investment in the Irish company here, US check-the-box elections have no impact, no domestic impact outside of the US for the most part, unless you're into kind of an anti-hybrid rule in your home country. So those investors in the Cayman partnership, they wouldn't generally be taking a deduction if they're non-US for those expenses of the Irish company. So you wouldn't need to worry about the fact that they're not including a share of income of the Irish company in that case, because there wasn't a double deduction to begin with.
Okay, so if we move on to our last category of examples. So these examples, we tried to bring together two sort of common structures that we'd see regularly, and just to think about some of the practical considerations. So what we're really going to focus on here is when you might actually have an associated enterprise. So our first structure is an aircraft leasing ABS structure where we have listed debt. So we have A, B, and C notes, and they're listed, and there's investors into that debt. And then we have a group of E-note investors which provide profit participating type E-note into the an orphan Section 110 company that's the issuer of both notes. So that Section 110 then lends down PPN funding into an Irish holding company, and then there's a mixture of debt and equity pushed down through the structure, and the aircraft are owned by the Irish aircraft owning entities down the bottom. If we work up the chain from the bottom, we can see the Irish aircraft owning entities are making payments to an Irish company, so there's no cross-border element. And similarly, that sort of follows the whole way up until the orphan Section 110 issuer. So we don't need to really assess the hybrid provisions on those payments that are within the Irish group. When we look then, we potentially have cross-border payments going out to the E-note holders and to the listed debt holders. We wouldn't expect that the A and B and C notes out to the debt investors would trigger any issue in terms of associated enterprises test, but it is something that would need to be considered at the level of the E-note holders. So are any of the E-note holders associated enterprises of the orphan Section 110 issuer? I think we went through on one of the previous slides that there are different thresholds that need to be applied when you're considering the different types of mismatches. And one particular mismatch that will be relevant in the context of an E-note is the financial instrument mismatches, which looks at differences in characterization of the payment that's being made. So it might be viewed as being debt in one country and in equity in another, and that difference in characterization means that the the income isn't included there. So in this case, the e-note holders don't actually hold any of the share capital in the orphan Section 110 issuer. So they don't. So when we look at the 25% threshold, we're not going to meet it on those sort of first tests, like the share capital or voting entitlement, those type tests. But where we still need to consider where you could still be an associated enterprise is if the Irish group is included in an accounting consolidation of any of the e-note holders, or if the e-note holders exert significant influence over the Irish group. That mightn't arise where you have a diverse pool of e-note holders, but it could potentially be the case if there's a single e-note holder or an e-note holder that holds the vast majority of the e-note. And that's very much going to depend on the facts and circumstances. But if there's an associated enterprise there, then you need to go through the different hybrid mismatch outcomes that could potentially arise to see if you can be caught.
And one important point to note here, I said earlier on that generally timing isn't an issue. This is the one exception. So financial instrument mismatches, in addition to the fact that the non-taxation would need to be because of a difference in characterization of the interest or the note, with financial interest mismatches, there is a timing point. And the default says you must include, as defined, if it's going to be taxable income, obviously, within 12 months. There is a rider to that says unless, right, you can be longer than 12 months if essentially that would be normal in a commercial sense. So therefore you can have accruals for beyond that if that would be commercially normal. And that, that probably wouldn't be commercially normal with a normal bank loan with ongoing payments, but you might have a bullet payment that you're accruing for, and that might indeed be deferred. In an ABS structure, I would say in a lot of cases there generally will be a good commercial reason for deferral of accrued interest on a PPN, because generally there's a commercial waterfall that says cash must be paid in this order and you can't pay out at the bottom of the waterfall until all these other expenses have been met. So I would say in a normal ABS, you would have a good defense there to say that's fine if it's beyond 12 months because it would be normal commercial practice. But obviously you need to think about other structures and whether or not that's that condition will be met in those instances.
Great, so moving on to our final example. I'm just going to touch on this one briefly. So here we have the investment, not an ABS here, but we have investment coming through a fund into a Section 110 issuer that flows down to a holdco, and then there's Irish aircraft owning entities. And when we look at the associated enterprises test here, we do have the shareholding coming down from the Cayman fund into the Irish group. And then also at the level of the investors, we might have a diverse pool of investors that are investing into the fund. And so we mightn't have an associated enterprise. We mightn't satisfy the associated enterprise test if we look at individual investors here. But one point that's worth noting is whether any of those investors could be considered to be acting together. And if they're acting together, then you would combine their shareholdings in the fund, which could potentially add up, and then you might actually trigger an associated enterprise test at the level of the investors. That's just probably the main difference or distinguishing feature between the previous example where we had an orphan group, and so those shareholding legs of the associated enterprise test weren't relevant.
Yes, and this partnership issue is a really tricky one, and it's going to be an issue for many people. What the rules say is that when you're looking at those equity type tests, so share ownership, entitlement to profits and so forth, you count together people who are acting together. There's no guidance in the law or in the revenue guidance on this point, and the question then arises if you're an investor in a partnership, and essentially with a GP then is in control of what the partnership does, then are you automatically acting together in that capacity? So there isn't good guidance. There is some commentary in the OECD which would support a kind of facts and circumstances analysis and might say, well, look, if the investors aren't actually acting together, they just happen to have invested in the same product, then maybe you shouldn't be caught. And there is some UK case law on similar wording elsewhere in the tax legislation that would say, again, you should look, the question of whether or not people are acting together. This wasn't, the case law wasn't looking at partnerships in particular, but as a general matter, suggested that it would need to be intent as well as ongoing acting together, as opposed to just a one-off situation. And so again, there may be some defenses there, but I would say the position is uncertain. And a reasonable presumption might be to think you have a problem if you have a fund structure that has a partnership that is an immediate receipt, and that needs to be more carefully thought about case by case. So that's the end of our examples. We've come through a few of the questions already, Cormac, but there's a few more. I might give you the first one, which is touching on a point I made earlier on. If you took a deduction on an accruals basis this year for paying for an amount, but it wasn't paid until next year, and it turned out upon payment that it was caught by the rules, what do you do? What do you have to do with your tax returns? Do you fix them next year? Do you go back and amend the prior year? What's the correct approach?
Yeah, so I think, I suppose it'll probably depend. It might depend on when the payment is made, in that you mightn't have actually filed your tax return for that period, even though it's accrued in the previous period. And I think the revenue guidance is helpful in relation to 2019, in that it says if there was amounts accrued in 2019 financial statements, but the payments made in 2020, that those amounts aren't in scope. But going forward, it is going to be necessary to sort of track accruals versus payments.
Thank you for that. Another question that we had in actually related to one of the previous examples, and actually a few people sent it in, so I will address it, which was where we were looking at that head lease sublease structure. So we had a US parent and two entities that were disregarded, so treated as branches in the US, one in Ireland, one in the UK. The Irish company had expenses that were deducted thus in Ireland and in the US, and then it had a head lease to the UK and a sublease to a third party. And we said the Irish rules are okay. They said that's okay because although the US isn't including the same income as the Irish company is including the head lease income it receives from the UK company, the US is including the third party lease income. Said that's okay because the Irish rules say, if the reason there isn't inclusion in the US is because there's worldwide taxation, then that's okay. And one of the questions came in was, or a couple of questions came in on the same point. Well, the head lease payment there would probably be lower than the sublease payment because there might be a profit earned by the UK company. That's okay, actually, that's fine. The quantum included in the US is greater than the quantum included in Ireland in that instance, and therefore there shouldn't be an issue because this is looking at Ireland. If for some reason there was a reverse, so if, for example, the amount included in the US for some reason was less, then you could indeed have a restriction in those circumstances, but that would be an unusual circumstance, I think. Another one for you, Cormac. Are there disclosures now in our tax returns? Do we need to notify anything to revenue in these circumstances?
Yeah, the short answer is yeah, there's a new page of disclosures in the form CT1, and it effectively requires the company to confirm if there are any hybrid mismatches that have arisen in the period. And then also there's a number of panels, depending on which hybrid category you fall into, you need to disclose details of the amount that have been restricted in the return. So, yes. That's great. Thank you for that, Cormac. I'm conscious we're coming up on time, but one last question, which I will field, is that there's a lot to take in here, and the question is there any easy way to try and deal with this? The rules are complex and they're broad, so it's not going to be all that easy, but there is some basic triaging that I think people should look at. I think the obvious examples is to understand what kind of entities you have and how they might be treated in different jurisdictions. So we've done a lot of examples, obviously, with entities that have made a US check the box election and therefore they're hybrids. So if you have those, then obviously probably more work needs to be done. If you don't, then you can probably say that's okay. But do think about those foreign branches. As I said, the US check the box election is really just an election to be treated like a branch, and branches can be hybrid entities too. In particular, if there's an exemption for branch profits in the parent jurisdiction compared to the location where the branch is, that can be an issue and needs to be carefully considered. So understand
what entities, what presences you have in different jurisdictions to try and identify, do you have any hybrid entities? And if so, then you probably need to do some more work. And then the other category, of course, is around hybrid instruments. And again, typically that's going to be debt that has some kind of characteristic to it. And that means that you're treated differently in 2 different countries. Bearing in mind, again, there does need to be a relationship here, so you don't need to look at all of your debt, but you do need to look at debt where it's held by people who have a shareholding in you, a 25 or 50% shareholding, depending, or where you're in a common accounting consolidation. And in those circumstances, there was probably a bit of work to be done just to check whether or not there could be any mismatch outcomes there. But beyond that, there's probably no easy way. Maybe the one other point to bear in mind is obviously it's cross-border. So you're obviously only looking at cross-border transactions here, things that are domestic within Ireland or indeed within other countries within the EU shouldn't be covered by these rules as it is a cross-border mismatch. So I think we're just over the 1:30 mark. So thank you, Cormac, and thank you all for attending today. As I said, this session has been recorded and we'll be releasing this afterwards. So thank you all for participating. Where you have other questions, please do reach out to your regular KPMG contact, and I'm sure they can help you. Thank you all. Goodbye.